Good afternoon, everybody. It's a pleasure to have a very good friend of our real estate program, Spencer Haber. He is the CEO and chairman of H2 Capital Partners and soon to be the chairman of the Zell Lurie Centers Advisory Board. Spencer, welcome.
Thanks, Chip.
We really appreciate you taking the time. It's our pleasure. I want to start out with a fairly broad question about what happened in commercial real estate and the debt side of the business in particular after the financial crisis and the Great Recession. We all know about the collapse of single-family housing and the great distress there. Some people believe there wasn't much distress in commercial real estate. Is that true, number one? And if it's not, how did it play out outside of the glare of publicity?
I'd say a couple of things. I think the distress in commercial real estate and debt got a lot less airtime than the distress in the residential world, and we could all talk about the reasons for that. It's less evident, more hidden from view. In the residential mortgage world, you have a mortgage, I have a mortgage. It was a very, very large problem in terms of dollars and very high profile. In commercial real estate debt, the numbers were quite large in terms of distress, but because of where that distress was distributed, I suspect that was one of the reasons it got less airplay. So I'll give you some numbers. So in commercial mortgages held by banks, the delinquency rate, the rate of loans that went bad, got as high as 9% of outstanding loans. And just to give you an order of magnitude, that number should be 1%. Less than 1%. It got as high as 7.5% in the early 90s when commercial real estate got a lot of publicity for being the black sheep in the financial world. But bank-held mortgage delinquencies actually got above that number in 2009, 10, and 11. And in the CMBS, commercial mortgage-backed securities world, the delinquency rate actually reached 10%. So you're talking about, in terms of dollars, so what does 9 or 10% mean in dollars? You're talking about $250 to $300 billion, billion with a B, of delinquent loans that ultimately translated into lender losses that were order of magnitude $100 billion, billion with a B. So those numbers feel like pretty significant numbers, and then that begs a question that you asked, which is, well, if it's $100 billion or $300 billion, how come it didn't get as much publicity? And I'd say, in large part, the folks who are bearing the pain were more distributed than maybe in the residential world. The borrowers were businesses, right? They were commercial businesses, real estate owners, not individuals. There wasn't as much of a public policy response because it was a commercial credit sector, not a residential credit, consumer credit sector. And because of commercial mortgage-backed securities and securitization, I just gave you the numbers, those losses were distributed between the banks and a very disparate group of investors. And I think for those reasons, it was a much bigger distress cohort than it got credit for being.
All right. Follow-up question for you. We are 5 years into a recovery. Employment's been growing since September of 2010. Is distress on the commercial side of real estate over, or are there going to be interesting things for your firm and others like yours to be doing this coming year and maybe the year after?
Well, I'd say a couple things. There was clearly a wave of traditional distressed opportunities if you're an investor, or challenges if you don't have capital. The challenges, if you have capital, they're an opportunity in that 2009, 10, and probably a little bit into 2011. For the last couple of years, the nature of the distress has been a little different. It's been deleveraging for sure. So old loan is $80 against a property that used to be worth $100. That property value has declined, or cash flow has not grown in pace with what the old leverage was. The leverage has to come down as it gets refinanced. But the nature of the distress is different, meaning when we all used to think about distress in the last couple of cycles, you'd think that the distressed opportunity was controlled by a financial institution, by a bank, by an insurance company, by an S&L, if you go back to the early 90s. Whereas here, the borrowers are largely staying in control of their asset. But because they need to get from old level of leverage here to new level of leverage lower, there's a recapitalization of sorts. And that distress tends to get a little bit less publicity, but there's still a deleveraging. I'd also say another thing, which is if you look at the cohort of 2005, 6, 7 loans that were 10-year loans, so they're coming due this year, next year, 2017, 2018. So this next sort of 3.5 years, it represents the maturity wave of really the worst of the last cycle, meaning those loans that were underwritten in 05 to 08 tended to have no amortization. So they're interest-only loans. And if you look at the history of commercial mortgage finance and you go all the way back to the 70s and the 80s, it's amazing what a little amortization can do for helping the credit quality of a 10-year loan. And it's interesting what the lack thereof does to the credit quality of a 10-year loan that was underwritten on peak cash flows. So we suspect that if you look at the amount of maturities in the next 3 or 4 years, which is about $1.2 trillion to $1.3 trillion, so it's a big trillion with a T, big number. It's not just the numbers, it's also the credit quality and the credit complexion of those loans, which tend to be legacy 05 to 06, 07, 08 loans. And so we think you'll see another wave of opportunities supported by clearly asset values that are still high because interest rates are low and cap rates are low, and perhaps we'll talk about that in a minute too, but where just the math of here's the old leverage, here's the new leverage, it strikes us that there needs to be a little bit of a squaring of that circle.
All right, so that sounds like an interesting business opportunity for some of our students.
We'll see.
Take us around the world. Take us outside of the United States now. We're recovering. Europe's not. Asia's slowing. What are firms like yours doing in terms of deploying capital around the world? What opportunities do you see for your sector of the business?
Sure. Well, people have asked us, frequently in the last several years, who our biggest competitor is, and I always say it's the Federal Reserve, and that's a serious competitor. And what I mean by that is that the amount of liquidity that the Feds push through the system, and just generally 0%, very low interest rates and free money, I think have created a challenge for any investor that's looking for a total rate of return or a yield. As that process gradually reverses itself in the United States over the next several years, you've obviously seen Europe go the other direction. And so from an opportunity perspective, there is clearly a deleveraging opportunity in Europe in this sector. The size of the opportunity, if you look at the total size of the outstandings, it's about €1 trillion, depending on how you measure. So in the U.S., the market's more like $3.5–4 billion. In Europe, the opportunity is about €1 trillion. So it's a smaller opportunity. It's less securitized. The CMBS market never really was a significant factor in Europe. So that changes how you get at the opportunities and also the scale of the opportunities, because in the U.S., the CMBS market didn't really have a mechanism to extend and pretend quite the same way the banks did, driven by the Fed's easy money policy. Whereas in Europe, because almost all the risk is bank held, if you think about what the ECB is up to, kind of repeating QE, repeating zero interest rate policy, I suspect what you'll see is that a lot of the traditional European financial institutions will be able to hang on and will in fact hang on longer than perhaps you'd expect or they should if you wanted to put a value judgment on it. But there have been literally tens of billions of euros of problem loan dispositions in the last several years. So it's still a meaningful cohort. And you've seen 50, 60, 70 billion euros a year for the last several years of financial institution dispositions. And we would expect that maybe at a slightly more muted level, there'd be several more years of that. And I think the primary thing that's driving that is, while the environment for distressed asset sales is more favorable to the financial institutions because there's so much liquidity and because there's so much money around, thanks to the ECB, the overall shrinkage of bank balance sheets in Europe is something that is inevitable. Our illustrious chairman, Zell, For the real estate center here, I think is one of his favorite quotes is that the three certain things in life are death, taxes, and that European bank balance sheets will be smaller 5 years from now than they are today. That creates an opportunity. I think the question is at what price, at what valuation, and the ECB is going to help there. In terms of Asia, I think in Asia, we just don't see the same level of opportunity in non-China Asia. So outside of China, I think we haven't really seen quite the same level of distress this cycle, and there are lots of systemic reasons for that. So less levered economies in some cases. I'm not really talking about emerging markets. I'm not so much talking about India here, but I'm really talking about Japan and some other of the large markets. In China, that's a completely different story, and we could have another entire talk just about that. But that, to me, is very much a function of trying to figure out the opacity of the Chinese financial market and institutions, the non-bank market, which is much publicized, a very large part of the shadow banking, the shadow finance system there. And I suspect that if one takes a 5 or a 10-year view, there will be enormous distressed opportunities in China credit. The question is, what does it take to really understand what the score is before you walk into the arena in those markets? And to date, that's something that we've thought that there's better risk return for us in the U.S. and in Europe.